All right, the weekend video, I'm going to talk about what is the most likely scenario over the next couple of years for the overall market. So we're hearing people talk about market crash, which we are basically in a bear market right now. But the question is, are we going to be in a bear market for years to come? Or is it going to be another 3 or 4 month dip and then we start moving higher? And I think I have a pretty good projection putting the dollar and then SPY, looking at them both and putting the pieces together. So if you zoom out here, we have 1, 2, 3, fourth wave was Corona crash, and then the fifth wave. So the question is this fifth wave finished right here? Is that the top? Or is that just the first wave of the fifth wave? So first wave of the fifth wave or the overall fifth wave? That's the question. And we don't know the answer yet because we're pulling back here. If it were to be the very top, we would have to minimum retrace to 262. And then obviously we would know that this just was the fifth wave right here. But if this is extended fifth wave, then it could look something like this. It could get a first wave, second wave pull back to 350 to 320, and then we blast off higher. And currently, if we zoom in on the chart, we have a pretty clear ABC zigzag pattern for the overall A wave. And based on the dollar, so we have ABC, and then we zoom in even more on the daily chart, we have A, B, 1, 2, 3, 4, 5. Presumably that's going to be B, and that's going to end between 420 and 430. If this was the bottom, which I don't think it is, because again, if you look at the fib retracements, we haven't even hit the 0.38 fib on, well, I don't think we have. Let's see where we're at on this again. If this were a second wave correction, we need to at least hit 350, like I said before. And so we're not there yet. So if this is the correction that we're going to retrace 50% of this move from 1993, then we definitely have to get to the 0.5 fib. If this is a second wave, we also have to get to the 0.5 fib. And so that conclusion right there just makes me even more confident that we are going to see more downside in the next couple of months. And then the only other possibility is if this is ABC and this is a short second wave, then that means we're just starting the first wave up of the overall third wave. So we would have 1, 2, and then be starting the third wave overall of this fifth wave. But the most likely scenario is that we're seeing ABC, zoom in again, and then we're getting A, B. This kind of looks like an A-B structure, 1, 2, 3, 4, 5, B, and then we see down. And how far down? Well, 350 is a 50% retracement. So if we do ABC here, 290 would be the 1.61 fib. So that is the 1.61 fib. 50%, you know, is 350. The way that this is going, if it hits 420, it will be about 50% retracement. That's a zigzag pattern. If we look at zigzag patterns, typically, let me double check this. Typically on a zigzag pattern, we're going to look for 61%, 100%, 123% are usually how far it would go. So let's look at 123%. 100% we know is right there at 362, but that's not far enough. It has to go to at least 350. So 123% would take us to like 337, 340. So I would say that the minimum that we're going to go is 340 because that takes care of a 50% retracement from this move to this move, and it also it hits the guidelines for a zigzag if it's not 100%. The next retracement is 1.23%. 1.23% is the minimum to get past 350 basically. So I think 340 is basically the lowest we would, or the minimum lower we're going to go. So we're at 412 right now. So you still have 72 points of downside minimum, and then all the way down to 290 or so. So 340 to 290 is kind of my target. And then if you go to the monthly chart and we look and just make sure that if this was the top, we'd be looking for minimum 263. However, remember 290 on the zigzag right now is the 1.61 fib. And so that basically, just looking at all those different things, makes me think that the most likely scenario for the overall market is 1, 2, 3, 4. This is only the first wave right here. And we're pulling back right now to the second wave between 340 and 290. That would be our second wave, minimum 340. And then we would go from the second wave way higher and then pull back and then go higher. So that's kind of, I'm not going to do my price targets on that right now. Kind of no point right now, but 340 to 290 pullback minimum. The other possibility is using that logic. We could also, we could be in the top right here too, and this is only the, remember we had to get to 263, I think. So 290 is 1.61 of the first scenario, but 263 is retracing 50% of the move since 1993. So if we had to get to that, let's say this is only the A wave of the first set of ABC. So A, B, and we get a move down here to 290 to 340. We could use even 340, and then we get a bounce. So let's say ABC, bounce for a B wave, and then we get one more move down here. And even at 340, that would hit perfectly the 50% retracement, the 1.61 of 340 to 480. I know this is kind of confusing to look at, but those are the two possibilities I see in the overall market. They both make sense because if we were to retrace all the way down to 340, we can look at the dollar now. And the dollar is currently what I think retracing for the overall fourth wave of this overall fifth wave. So we have 1, 2, 3, 4, 1, 2, 3, 4, 5, and that completes this whole cycle. That started in 2008. So then we would pull all the way back to low 90s to 80s. And so with that being said, if we get a move from 115 in the dollar, that's kind of where I think it's going to go, all the way down to 90 to 85, I think that that supports the first scenario the most. The scenario where this is a first wave, second wave, third wave, and we go to all-time highs in the next couple of years, over the next 2 or 3 or 4 years. I think that's the most likely scenario, but it could be also that we fall to 290. Like I said, that's the 1.61 of this ABC move, 290, and then we bounce for a B wave as the dollar is losing strength, and we could even top over this, and then we fall even farther as the dollar starts going to my target for the third wave of 142. And so that would look like ABCA, B, C, and then we would get A, B, C, B, and then we would get a 1, 2, 3, 4, 5 down here to crazy lows. So I guess with this whole video, I'm projecting 2 different possibilities, but what I'm saying is basically when we hit 340 to 290, 340 to 290, I would be buying as much of any stock that you can, that you're bullish on, because that's going to be the bottom of this bear market. 340 to 290, we'll have to see more accurate targets later. And once you get to that area, you need to buy as many equities as possible because the dollar is going to get a lot weaker. And when the dollar gets a lot weaker, equities will go up. Prices will probably go, inflation will probably go crazy at that point. And it might even be, it's probably going to be hyperinflation at that point. But if you're buying down in here, then you should be able to keep up with inflation pretty well when the market makes all-time highs. So I just wanted to make that video. I'm pretty confident that we're not seeing the Great Depression type of crash right now. We're just in a bear market, and that we will probably, higher percentage of the time, I think we're going to see all-time highs. We're going to see a third wave, fourth wave, fifth wave, rather than ABC, ABC, and then a 5-wave move down. I'm leaning towards the scenario where we go to all-time highs. So that's just kind of my thesis right now. We'll see what happens, but I wanted to lay that out for you. If it gets to 340 to 290, just buy as much as you can, because it's going to at least go up to the top, most likely 480 again, but most likely go even higher to like 600 or 550 or so. So just a little deep dive going in for the weekend. Let me know what you think in the comments, and you think that's possible, and how are you playing the market right now?